So this is part 2 in our series of Introduction to Financial Accounting. And in this part, we're going to be specifically talking about the accounting equation. So first, let's look at the actual accounting equation. So we're going to start with assets, and we'll talk about these in detail here in just a second. So this is the actual equation. Assets are equal to liabilities plus owner's equity. Assets can be defined as economic resources or future economic benefits. So let's look at some examples of assets. These are some common examples: cash, accounts receivable, inventory, equipment, and land. Most of those probably sound pretty familiar to you. Maybe accounts receivable may be a little bit new to you. Accounts receivable is when you sell something or perform a service and the customer doesn't pay you immediately, so they owe you that money. That's called an account receivable, when you're owed the money for performing a service or selling a product. Now think about the definition of assets. We called it a future economic benefit. Cash seems to be the more difficult one for students to understand how that's a future economic benefit, because I've got the cash in my hand right now, but the cash isn't really doing anything until I pay a bill or purchase some inventory with it. Therefore, it becomes a benefit when I use it. Therefore, cash in hand is a future economic benefit. So the second part of our equation is liabilities. Liabilities is defined as creditors' claims on our assets. Again, notice the equation. Assets equal liabilities plus owner's equity. So this is the creditors part of our assets, more commonly known as our debt. Some examples of liabilities would be accounts payable, salaries payable, rent payable, utilities payable, and notes payable. Notice a common theme there, the word payable. So anytime you see the word payable, that means you owe something to someone. The other side of the equation is owner's equity. This is the owner's claims on the assets. And it is made up of, for our purposes right now, we're going to specifically talk about two things it's made up of: stock and retained earnings. Now, most of you know what stock is, and later on we'll be talking about another form of stock other than common. But what I want to focus on really quickly is retained earnings and what that is. Retained earnings are earnings that a company retains and does not pay out in the form of dividends. So therefore, retained earnings is affected by net income and dividends. Net income will make retained earnings go up, and dividends would make retained earnings go down. So that's very important at this point in the discussion that you understand that. So let's look at a little practice with our accounting equation. So let's remember our accounting equation is assets equal liabilities plus owner's equity. So the first example, let's look at Cougar Rentals. So in this case, we don't know our assets, but we know liabilities and owner's equity. Can you find assets? Sure. It's a very simple equation. Assets, which we don't know, that's our unknown, is equal to $60,000 in liabilities plus $21,000 in owner's equity. That makes our assets equal to $81,000. And we'll look at Washington Photo. In this case, we don't know liabilities, but we know assets and we know owner's equity. So a simple moving around of the equation, I can find liabilities. And then we'll look at Portland Nautilus. We know assets are $100,000, liabilities are $79,000, but I don't know owner's equity. Can I find owner's equity? Sure. Again, we'll move the equation around and locate owner's equity. So try that right now. Try Washington Photo and Portland Nautilus and see what you get. So again, we found $81,000 for Cougar Rentals. You should have gotten $32,000 for Washington Photo and $21,000 for Portland Nautilus. Now here's a little more complicated example. So what I'd like for you to do is pause the video here, work on this example, and then come back and we'll review it together. So I hope that you have worked this problem out. You paused the video and now you're back to see how you did. So we'll take a look at this. Ruth Landscaping started 2007 with total assets of $22,000 and total liabilities of $10,000. At the end of 2007, Ruth's total assets stood at $30,000 and total liabilities were $14,000. Did stockholders' equity of Ruth Landscaping increase or decrease during 2007, and by how much? So the first thing you should have started with is your accounting equation. You should have set it up. Assets equal liabilities plus owner's equity. Now they tell me a little bit of beginning and they tell me a little bit of ending. So you should have labeled everything. So we'll start with beginning and we end with our ending. So they tell me my beginning assets were $22,000 and my beginning liabilities were $10,000. So again, I'm just filling in my equation. They tell me my ending assets were $30,000 and my ending liabilities were $14,000. Were you able to find your beginning owner's equity and your ending owner's equity? Just like we did before, beginning owner's equity is $22,000 in assets is equal to $10,000 in liabilities plus something. That something must be $12,000. If we rearrange the equation where owner's equity is equal to assets minus liabilities. So $12,000 is equal to $22,000 minus $10,000. Now, were you able to find ending owner's equity? Again, something is equal to $30,000 in assets minus $14,000 in liabilities. Again, just moving my equation around a little bit algebraically. You should have got ending owner's equity of $16,000. Now, that's not the answer to the question. The question is wanting to know how did owner's equity change during 2007? Well, we started with $12,000 in owner's equity, and we ended with $16,000 in owner's equity. That's a $4,000 increase in owner's equity. Now I'd like for you to think how or what could have made owner's equity change. So identify two possible reasons for this $4,000 increase in owner's equity or stockholders' equity during the year. Net income, as we stated before, could have made owner's equity go up. In addition, we could have issued stock. Issuing stock would have made owner's equity go up as well.